Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today we're going to talk about something a little different and something that you just may not expect me to talk about, right? You may not expect me to advocate for selling your stocks, right? But today I'm going to give you some good reasons why you may want to do so. Right. And this is not me being a market predictor. This is not me saying that I know something that major market pundits don't know. And it's also me not saying that you should throw investment principles out the window. It's just simply me saying that sometimes there are good reasons to sell, even when the overall sentiment of investors should be to just hold on and keep buying. Right. And so I want to give you those good reasons, give you things that, hey, if you're going through this specific situation, then maybe you should sell your stocks. But this is something that, you have to ultimately make the decision. It's just me laying this out on the table for you and letting you better understand what your situation may be and how you may need to act on the other side. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, look, make no mistake about it. We have had quite the month when it comes to investing, right? We've had a lot of downs, even some, bounces back up. We've had some days where, we've started really up and then ended down. We've had some days where we started way down and then actually ended up, right? There have been just some major swings in our investments this month, most of which being downward, right? But I think that we need to have the right to hear some things and to hear two different sides of the same argument and not get them misconstrued as being contradictory to one another, right? There are things that you can do on both sides of your investing life that are proper, are the right things to do, and yet they contradict one another, at least in the decision that you would make, right? So you hear quotes from people like Jack Bogle, who started Vanguard, right? He used to say, don't do something, just stand there, right? When markets are going down, don't worry about doing something. Don't just stand there, keep doing what you're doing. Warren Buffett says, be greedy only when others are fearful, right? And when markets are going down, others are obviously quite fearful, and so be greedy, buy, right? Shelby Cullum Davis said, you make most of your money in a bear market. You just don't realize it at the time. So you make your money in those buying opportunities. Okay, now stocks have been volatile recently, seesawing all over the place, right? But they've mostly trended down. The S&P 500 has been below the 10% mark a couple times already this month in that correction territory, and the NASDAQ 100 has been lower than that. You don't have to be an investment legend to know that it's rarely wise to be a seller in such environments if you can avoid it, right? You don't want to sell something as it's going down in value for multiple reasons. One, you're not going to get an adequate, price for it that you could have gotten if you just waited, right? And two, who's to say that it's not going to just continue upward in value over a long period of time? And then when do you get back in? When do you get back in on such an investment? The answer is who knows? And then, you'll miss. You'll likely either miss as it's going down, or you'll miss as it's coming back up. Now, selling into a downturn violates one of the key tenets of successful investing: selling high, right? We want to buy low and sell high. That's what you're taught to do as an investor. And investors who panic sell are prone to make emotional decisions that undermine the success of their own plans. Even the emotional relief that selling might bring is fleeting, and it's often quickly replaced by another nagging worry: is it time to get back in? Right? We tend to have a lot of regret when we sell, especially as things are going down. Now, for all of these reasons, the admonition to stay the course in a falling market is often, indeed usually, sound advice. But it also presupposes a few things that may or may not apply. Right? The biggest is that it assumes that the underlying investment plan and allocation are well thought out and well tended, right? We have this thought process of, you don't sell, well, you should have the thought process of not selling as things are going down, but maybe you don't have the proper, allocation. Maybe you don't have the proper risk taking in your portfolio. And we'll talk about that here shortly. That may be a problem that you have, and your portfolio just may not be one that was well thought out when it was put together, and now you are seeing the negative sides to not thinking it out well. Now, at least until recently, we were living in an era of FOMO, fear of missing out, right? Everybody was jumping into speculative assets, and many novice investors, barreled into risky assets with hopes of overnight riches. Right? It's a big leap to assume that many of these newbies were operating with an underlying plan or even an appreciation of investing basics like asset allocation, diversification, and the role of time horizon. And if you ever think that those things don't work, then just look at market downturns and look at the mass exodus among those new retail investors as they, basically got punched in the teeth by the market. Now, even investors who did have a plan at one point in time may well have found themselves without contact to that plan anymore, right? U.S. stocks have trumped almost everything in sight over the past decade. Cash, bonds, non-U.S. stocks, you name it. A portfolio that was 60% U.S. stocks and 40% bonds 5 years ago would be 72% stocks and 28% bonds today. And that simply means that the bonds would have depreciated in value relative to the stocks. Yet, getting investors to peel back on a winning asset class in favor of one with a dinky yield, such as cash or bonds, or underwhelming long-term results, such as international stocks and also cash and bonds, is an uphill climb, right? Just as important, many investors' natural tendency is to do nothing with their portfolios, often for years on end. And that's especially true when the market is marching steadily upward, right? They may have heard the advice to rebalance, but they're busy or not too sure how to do it. They take the path of least resistance, just do nothing. Now, for all of these reasons, I think that there are plenty of investors who should, in fact, be lightening up on stocks during the current market. And I know that's not a popular thought, but there are definite situations, and that's the whole point of today's episode, when selling is appropriate. Now, I know that conventional wisdom says to do nothing, and I think the vast majority of you should just do nothing. I'm not saying this today in order for everybody to run in and sell their stocks. I'm not giving you, the permission to go in and do that. I'm just saying if there are certain situations in your financial life that are occurring, that are real right now, then going in and doing some selling might not be the worst thing. All right, so here are a few situations when selling stocks might be warranted right now. Okay, so we'll start with the first. The first reason is you're getting close to retirement and or you need to de-risk, right? As you talk to older adults, right, and people who they have had to take some risk off over a long period of time, right? Even as our comfort level with risk taking usually grows as we get our sea legs as investors, our plan's ability to absorb risk usually diminishes, right? I think that explains why it's so tough to get older investors to de-risk their portfolios in the years leading up to and in retirement, right? They've seen this movie. They know stocks usually recover, and their stocks have been, beating everything else in their portfolio by a large margin, right? And stocks' current run, which dates back really to 2009, the big losses that stocks endured during the great financial crisis, they've been very much erased and far since left in the past. Right? Is it any wonder that so many older investors are standing pat with equity-heavy portfolios, right? What else do you expect? Do you expect people to just not want to be a part of the greatest bull market that the American stock market's ever seen, right? Of course, people wanted to be involved, and they were involved, and they've made a lot of money, and they've likely seen their accounts make a lot of money over time. So it's going to be hard to tell people who probably don't need to take as much risk that it's time to not take as much risk. It's time to sell some of their stocks. Now, this doesn't mean in all cases that now's the perfect time to do so, but it may mean that, some rebalancing is necessary, because there has, obviously there's been pullbacks along the way. There's been corrections. There's been, the coronavirus crash, right? The market dropping over 30%, but then just coming right back and then roaring upward. Now we're seeing this, basically this fade over this month, into lower and lower stock prices. And the daily pain of a declining market can be hard to deal with. Now, even as risk tolerance grows with experience, risk capacity, or the ability to absorb big losses in our equity portfolios, declines as we get close to drawing funds from our portfolios, right? This is natural. It's natural to maybe look at yourself, and I talked about investor behavior types yesterday, and I'm an independent, right? I'm somebody who will do the research for myself, maybe take on a little more risk, right? And know what's best for myself based on the research that I've done, and try new things and things like that, right? And I may feel perfectly okay with taking a certain level of risk. But the problem is that if you're getting close to taking money out of your portfolio or needing to draw down from your portfolio, then the risk that you want to take, right? The risk that is, maybe even necessary to take for people who are younger or further away from, an ultimate goal in their retirement lives and their financial lives. Maybe my portfolio doesn't look like theirs. Maybe I need to do things that they don't, right? And that's what I'm trying to suggest right here. All right, at that life stage, it's wise to begin building out positions in cash and bonds as basically, your hedge against risk, right? Your stability in the portfolio that you have. Now, if a lousy market materializes early in retirement, the investor can spin through the safe stuff versus tapping depreciating equity assets, right? Heading off a sequence of return risk helps explain why bucket portfolios generally hold 10 years worth of spending in cash and bonds. Now, we can talk about buckets here in just a second, but I don't necessarily think that they should hold 10 years worth of cash and bonds. That's a bit excessive. Now, it's also why in our recent research on, in retirement, it's also why in recent research on in retirement withdrawal rates, people find that the balanced portfolios generally supported higher withdrawal rates than more equity heavy ones. And the basic reason for that would be decreased volatility. So this whole first reason for going in and selling stocks right now would be to do a couple things. One, if you realize that you just can't deal with the volatility as much, in a very equity heavy portfolio, it may be perfectly okay to rebalance into some bonds, right? Rebalance into some spots where, it'd be more beneficial for you over a long period of time, right? Take the proper risk. Now, as much as I say this, I gave you a rule from Josh Brown last week that basically said, don't be risk off now, right? Don't be, once you've already taken the ride down with the risk that you've taken, don't be risk off now. Continue that risk until things, normalize. And I think that's probably a good idea for most people, right? I don't think you should make major changes to your portfolio allocation until we kind of normalize in markets. But I do think, right, if you're getting close to retirement, if you're, getting close to having to take money out of your portfolio and you're going to need that money to live on, then by all means, feel free to get a little more stock light. Now, again, is it the perfect time to sell? No, right? But when is the perfect time to sell? Because otherwise you may sell when the market's up, right? But maybe the market keeps going up, so you missed out on some of the gains, right? It's not a matter of timing the market. It's a matter of taking the proper risk at the proper time. So this would be a reason that I think, you can go in and do some selling if you are very close to retirement and you need to de-risk. Now, a second reason is that you may have a short-term investment goal, right? New investors have been flooding into the market during the pandemic thanks to strong gains on stocks and other assets, as well as the fact that many investors have had extra time and extra cash to invest, right? They used to not have as much time on their phones because they were at work, right? Or they got these stimulus checks and didn't necessarily need them. And so what do? Invest or speculate, right? Research in 2021 from investment firm Charles Schwab found that these newbies have a median age of 35 and their incomes are about $20,000 less than investors who were in the market pre-pandemic. Half of the new investor group, which Schwab calls Generation I, are living paycheck to paycheck. A healthy share of the new investor group was expecting to hit big lifetime milestones within the next few years, such as buying a home or having a baby. And as somebody who had a baby last year and will likely be buying a home this year, right? This is something that you need money for, right? Both of these things are things that you need money for, right? And hitting these things is no, financial walk through the park. These are big expenses, and these are big cash outflows that you just have to deal with. Now, the statistics suggest that some new market entrants are not laser focused on amassing investments for their retirements in 30 or 40 years. Rather, they may need to tap their portfolios sometime soon to cover an emergency expense, tide them through job loss, or fund some shorter term non-retirement goal like a house down payment. If they need to get out of their stock investments at an inopportune time, they could lock in losses. And this is very, very true, right? You can get out of some stocks in order to take care of some short-term goals. And there's nothing wrong with that. There's nothing wrong with going and trying to buy a house, right? And needing the money for the down payment and selling stocks when they're down in order to get that down payment. There's nothing wrong with that, right? There's nothing wrong with you're going to have a baby. You need to make sure that you have the cash there to have the baby. Then you can sell some stocks at a loss. Now, for a bit of context on why investing in stocks for short-term goals can be so risky, over rolling 10-year periods since 1986, the S&P 500 has posted a loss roughly 18% of the time. So that's 10-year periods, right? Not 1-year periods or 5-year periods. The index has posted losses in about 12% of 3-year windows over that same stretch, right? Some of those short-term losses were punishing, especially in 1-year windows. The unlucky soul who invested in the S&P 500 in early 2008 and needed to get his money out a year later would have had to settle for a 43% loss, for example, right? So short term is not the name of the game when it comes to investing. And if you need money in the short term, then putting it in the stock market may not be the right thing to do. Or if it's already there, then doing some selling to get your money out may be the proper idea. Now, with U.S. stocks still up more than 10% over the past years, Now, with U.S. stocks still up over 10% over the last year, new investors who find themselves with too risky portfolios should feel absolutely no shame in liquidating some of their equity holdings in favor of a portfolio mix that adequately reflects their potential need for liquid assets in the next few years. And I would even suggest that if you need money because let's say you're pregnant or your wife is pregnant, or you're going to have a baby, regardless of who's pregnant and how, but you're going to be a mother or father, right? Then you need to go ahead and get cash saved up for that, right? Or if you are going to have a house down payment and you've got less than 3 years in order to do so, then you shouldn't be investing anything for that. That needs to be in cash, okay? So if you have a short-term investment goal, by all means, do some selling and create some cash for yourself in order to take care of that particular need, right? So close to retirement, you need to de-risk. You need to de-risk because you have a short-term investment goal or a short-term financial goal. Then by all means, take advantage of selling some stocks now. Now, the third reason that you may be warranted to sell some stocks is that there's a chance you'll capitulate if things get worse. And you may say, okay, Dylan, you used a big word. What does capitulate mean? Now, capitulate means cease to resist an opponent or an unwelcome demand or surrender, right? So you may surrender if things continue to get worse. So I'll continue to explain. The preceding two situations relate to risk capacity, right? So having a short-term financial goal, you're nearing retirement, you need to de-risk, right? Those relate to risk capacity, where too aggressive portfolio may be at odds with someone's spending horizon. In other words, the spending goal dates could force a liquidation at an inopportune time, or even worse, force them to change their goals and their plans. But even if an investor has an adequately long time horizon to hold stocks, there's another issue that can crop up with too risky portfolios, and that's capitulation risk, right? This refers to the chance that investors could become so nervous during periods of losses that they sell themselves out of stocks, thereby turning paper losses into real ones. And we've heard about this all the time. The loss doesn't exist until you sell. Well, they feel quite real at the time, but it is true, right? Paper losses can turn into real ones when you actually sell the assets that are down in value. So for investors who have found themselves inordinately spooked by recent market volatility, it's wise to use it as a wake-up call to make some changes, even if their portfolio's equity exposures seem right on paper. After all, recent market losses are minor relative to the depth and duration of some of the previous market downturns. The S&P 500 lost half of its value in the bear market that began in March 2000, for example, and that bear market was a grinding one lasting 31 months. The bear market that ensued during the great financial crisis was quite a bit shorter, just 17 months, but the losses were even sharper, 56%. In other words, if the recent market volatility has you spooked, you ain't seen nothing yet. And I was reading the other day about market corrections and how the average, I don't know if it goes back 100 years or just back to 2000. I don't know how recent the data goes back, but the average correction was 13+%, right? And we haven't come near that as a correction in the S&P 500 yet. And we know the age-old stat where the S&P 500 has on average one correction per year, right? So it's not surprising that these types of things occur. Now, while throwing stocks overboard won't make sense, lightening up on stocks while adding a bit more to bonds and cash just might. In addition, nervous investors can take a closer look at the complexion of their equity portfolios, making sure that they have a balance between value and growth stocks, hold some non-U.S. as well as U.S. stocks. Alternatively, investors might use their response to the recent market action as an impetus to delegate their portfolio management to a professional advisor. Doing so can help to reduce the worry, ensure a situation-appropriate asset allocation, and help protect the investor from his or her own worst impulses to trade at an opportune time. So here's what I think about this. I think it is absolutely true that you need to take the right risks and you need to have the right asset allocation and the right portfolio for you. And you may not have known that you didn't have the right portfolio for you until we got into the situation where markets were going down. Now, I go back to saying that it's not the smartest thing to do to de-risk at the bottom, right? Because naturally, risk and return have a positive relationship with one another. And if you've been taking risks to this point and you've ridden the market down, right, to de-risk at the bottom is really the same as selling at the bottom, right? And what do we know about selling at the bottom? Getting back to the values that we had previously, it's going to be far more difficult. But sometimes it is just more valuable to us as investors to have the proper asset allocation. Now, here's where you know if it's time or not, if you should make these changes, if you should keep yourself from capitulation or not. The reason you'll know is because if the market continued upward, would you want to get out of those less risky assets and jump back into risky asset classes? And if the answer is yes, then it's not that you've taken the wrong amount of risk, it's that you're out here chasing returns, right? And you don't like taking losses. Nobody likes losses, right? You need to understand that nobody likes losses. But if the market were to go back up and it would have very little impact on you relative to the impact that the market going down has had on you, then it may very well be time to lighten things up. Look, I'm just all for you having the proper risk taking, but we need to be doing this for the right reasons. We don't need to be out here chasing return or de-risking at the bottom and taking more risk at the top, which unfortunately so many investors do. So many investors get into this process of when the market goes down or dips or crashes, then they end up taking less risk. They end up getting into bonds or cash. And then when the market is hitting its top, they're investing in ARK, and they're investing in Bitcoin, and they're speculating in all these things, speculating in Tesla and all these different things, right? And then you get the worst of both worlds when it comes to your investment returns, which is not what I want for you. So I want you to take a real good look at your portfolio before you try to make such a decision as this, but make sure that you actually have some imbalances and then get those imbalances fixed. And you don't have to do all your selling at once. I think that's a very important caveat to what we're talking about today, is that even though you may sell stocks, you may do so slowly. You don't have to sell all of the stocks to rebalance in a certain way. Maybe you do so slowly, right, to make sure that you can alleviate some risk over time. It's very much the opposite of dollar cost averaging, or I guess it'd be the same as dollar cost averaging, because you're dollar cost averaging into new assets, but you're doing some very scheduled selling over time to invest in lower risk assets. Okay, so that may be a reason as well, but you need to be very careful about your own self-awareness and your investing life there. Then the fourth reason that you may do some selling is you have tax losses. Okay. Now, granted, this is a niche case, but for investors who recently purchased securities in their taxable accounts that have subsequently declined, selling to harvest a tax loss may be a way to find a silver lining. So the key here is investing in a taxable account. So not an IRA, not a 401k, not any type of tax advantaged account, but in your taxable, brokerage account, because you can deduct your tax losses from your income and from other capital gains that you may have over the course of the year. Now, those losses can be used to offset capital gains, or if losses exceed gains, up to $3,000 of ordinary income. Now, just be sure to consider the wash sale rule if you'd like to maintain ongoing exposure to an asset. If you plan to rebuy the same or substantially identical security within 60 days of making the sale, you'll disqualify the tax loss. That's very, very important, right? You can sell in your taxable accounts in order to realize a loss that you can deduct from your capital gains and or ultimately deduct from your income up to $3,000, right? But if you take a substantially identical investment, decision or position, that's the word I'm looking for, position, within 60 days, then you will disqualify the tax loss, and you'll still be on the hook for the loss, but you won't get to deduct it, right? Because they want to make sure that you're not just selling to get the deduction and then going right back in and buying basically the same asset. So maybe you do a little change in your allocation, or maybe you invest in something that's a little different. Maybe you go from something that's large cap to something that's small cap, or the other way around. Maybe you go to international stocks instead of domestic, or a balanced portfolio instead of all stock, or whatever, right? But you can sell, reinvest that money, and reveal that tax loss. Now, I wouldn't suggest this for everyone. I would definitely suggest it for people who expect to have large taxable gains this year. But if you don't expect to have large taxable gains, you don't have a taxable brokerage account, whatever, right? Then this doesn't apply to you. I don't think this is something that everyone needs to do, because this is just going to create churning and unnecessary selling at an unnecessary time. Otherwise. But if you do expect to have substantial capital gains that you would like to offset this year, then by all means go ahead and take some of your stocks off the table. But don't do it in a permanent manner. Just sell your stocks in order to take back other positions. But again, you need to be careful about what those positions actually look like relative to the position that you sold. And this can be very easy. If you sell an individual stock, maybe you sell an individual stock at a loss and go buy an index or buy a mutual fund, whatever, right? You can ultimately, realize some tax losses and have, a more favorable tax situation at the end of this year. Now, other than these four reasons, I don't see any reason to sell stocks, and I don't think anyone else should. There may be some very, niche decisions that need to be made where, stocks need to be sold. Maybe somebody passes away. You have to get to money very quickly. Maybe that's the case, whatever, right? But ultimately, we need to hold on. We need to keep buying. We need to see this as an opportunity and as a sale for us, and not for a time to run for the hills. But there is perfectly good reasoning to sell stocks for certain individuals at certain times. But for the vast majority of us, it is going to be hold on, continue on. Don't waver from your investment decisions, and don't waver from the plan that you have for yourself. And you'll be thankful that you held on to that good investment plan and this good investment advice over a long period of time, because you will make better returns because of it. So thanks for watching this video. If you could, go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.